Hi, this is Mahrukh with Mahrukh Tariq Associates, and we are here to discuss a very important question, which is a lot of my client is asking me that how is the war with Ukraine is going to impact interest rate. And I have here a very knowledgeable lender is Scott.barr from US Bank. He's been in the business for 20 plus years and do more than 100 loans per month. So no one could be answer this question better than him. So I really appreciate he's joining us today and educate our clients. So Scott, thank you so much for joining us. The question is rising about this war have begun. How is actually going to impact lending or interest rate, let's say?
Well, Mahrukh, thank you for having me. I don't anticipate that, and the industry doesn't anticipate that there'll be any negative impacts per se to guidelines with regard to the war. In other words, there won't be a tightening of lending structures, if you will. We anticipate that things will be pretty much business as usual for that. Having said that, anytime we have uncertainty in the world, certainly the Russia-Ukraine conflict creates uncertainty for the markets. It creates uncertainty for the stock market, as we've seen. And by extension, it also creates uncertainty in the bond market. And the bond market is really how mortgage interest rates are determined. So what we do think, and what we have seen is that the sanctions that the Europeans and the U.S. have put on Russia have had a negative impact on commodity prices. Russia is the second largest producer of oil in the world, so certainly cutting off the Russian banks from easily trading has impacted commodity prices. We'll continue to see probably a spike in oil prices. There's been some talk that we'll probably see at the gas pumps in the U.S. up 20 to 30 cents per gallon. So about a 10% rise there. And so what that's going to mean, obviously, is higher interest rates. It means a greater, because, and when I say obviously, that's not necessarily fair, but what I mean is that as commodity prices rise, inflation impacts, and therefore you'll see higher interest rates, because interest rates are essentially the amount that somebody gets on a bond, or the interest that is charged has to reflect whatever the interest rates are in the market. So as commodity prices go up, you see interest rates rise. And so we're anticipating that this is going to make the job that the Federal Reserve has right now to try and control inflation even more difficult. And so we'll probably see interest rates rise. How much? Hard to say. We do know that the Federal Reserve over the next 12 months or so is probably going to raise interest rates 5 to 7 times. Every 6 weeks, starting in March, they're going to raise interest rates. What the markets are anticipating is 0.25% every 6 weeks for probably the next 5 to 7 meetings. And the meeting cycle is every 6 weeks. So there it is.
So where do you predict it may end up, like by end of 2022? Because at the moment, the interest rate just, spiked to 4% from somewhere, higher 2s or early 3s. Now it's 4%. So where would we be looking then by end of this year?
Yeah, we're probably going to be in the low 5s is what generally is the feeling. Now, we say that we make these sorts of prognostications, and somebody sneezes somewhere in the world, and everything goes crazy. But generally, we're anticipating that mortgage rates will probably be somewhere in the low fives.
And how is going to impact the buyers? Because what buyer could afford when they were qualifying on 2% or 3%, and now it will go up to 5%. How would it impact on the consumer buying power then?
Right. So what we find in our industry is that for every 1% rise, there's about 1 million people in the United States who will be negatively impacted in terms of what they want to buy. The industry at the beginning of the year, the Mortgage Bankers Association, had anticipated that we would see approximately a 9% rise in purchase activity in the United States in 2022 as compared to 2021. There's a lot of things that are impacting that, as you know, Mahrukh. One is no houses. When I say no houses, what I mean is that there are very few people that are selling their homes, and as a result, we've continued to have this craziness that is occurring in the markets right now, and the struggles for buyers as they compete with other buyers to try and write contracts on the few homes that are out there. I hate to put it that way, but that is one of the struggles that we see, and we see it at all price ranges. It's we see it at the $90,000 home in York, Pennsylvania, and we see it in the $2.6 million home in Las Vegas, Nevada, and we see it in Washington D.C. in the $800,000 range. It's going to be a struggle for buyers in 2022 as again that continued uncertainty, where interest rates going means people don't put their houses on the market, and that's what we have. So
okay, well, thank you so much, Scott.
For all that positive news, I know. Wow.
But whatever it is, we have to share with our clients. So thank you so much for joining us today. And if you guys have any questions, please let us know. We will be more than happy to help. And we will see you next time. And you can see my and Scott's information below. So you feel free to reach out to us anytime. Thank you, Scott.
Thank you.